Okay, what if I told you that you could take a totally standard 10-year investment and, with just a few clever tweaks, turn it into something, well, something extraordinary? Today, we're going to break down a really fascinating strategy that claims to do exactly that. Let's get right into it.
First things first, we need a baseline, right? So picture this. You're putting 5,000 rupees a month into a regular SIP. You do this for 10 years, and let's say you get a pretty standard 12% return, kind of like what the Nifty offers over time. At the end of it all, you'd have about 11.6 lakh rupees. You know, a solid return for sure. But what if we could aim a little higher?
And when I say higher, I mean a lot higher. The source material we're looking at today sets this absolutely audacious goal, taking that very same 5,000 rupees a month and turning it into over 1 crore rupees. And get this, in the exact same 10-year window.
Yeah, that's the big question, isn't it? I mean, it sounds almost too good to be true. But the strategy is actually based on a few very specific, practical changes to how you run your SIP. So let's break down exactly how the source says this could be pulled off, one step at a time.
So the first step on this journey isn't about earning more money. It's actually about losing less. According to the source, the real villain in the story, the thing holding most people back, is the bunch of hidden costs you find in traditional mutual funds. These things can just quietly drain your returns over the years.
First up, you've got something called the expense ratio. It's basically an annual fee the fund charges just to manage your money. And here's the kicker. If a fund has, say, a 2% expense ratio, that means for every 1 lakh rupees you put in, 2,000 rupees is gone. Poof! Right off the top, before your money even gets a chance to start working for you.
And then there's this thing called an exit load. You can think of it like a penalty for cashing out too early. If you need your money back within a year or two, the fund might hit you with a fee, sometimes as high as 4%, which comes directly out of your final amount.
So you can see how this works, right? It's like a 1-2 punch. The expense ratio shrinks your investment from day one, and the exit load can get you on the way out. Over a decade, the combined effect of these fees can really add up, acting like a constant drag on your portfolio's growth.
So how do we fix this? Well, this brings us to our very first major modification. To get around this whole cost problem, the source suggests a really simple but powerful move, switching your investments from those traditional mutual funds over to exchange-traded funds, or ETFs.
And here's why that switch is such a game changer. ETFs that track the same stuff often have way lower expense ratios. We're talking like 0.05% compared to 1 or even 2%. Plus, they almost never have an exit load. And you can buy and sell them anytime the market is open, just like a stock. So at the end of the day, you're getting the same investment mix, but for a fraction of the cost.
All right, on to the second modification. This one is a little more hands-on. It's all about changing when you put your money in. So instead of just letting your SIP automatically debit on the same day every month, you actually take over the controls yourself. And this is the whole idea behind the buy the dip strategy. You let your monthly 5,000 rupees just pile up as cash in your account. Then you only actually invest that money on days when the market is in the red. The logic here is super simple. You're basically buying your investments when they're on sale.
Let's break down how that actually works. Let's say the market is up for a few days in a row. You do nothing. Your cash just sits there, building up. Then, bam, the market has a down day. That's when you jump in and invest all the cash you've saved up. Over time, doing this over and over again lowers your average purchase price. The source claims this alone can generate alpha. That's just a fancy word for beating the market and could potentially boost your returns way past that standard 12%. Okay, now this is where things get really interesting and honestly a bit advanced. The final modification is about using the investment you already have to create a whole second income stream. We're talking about pledging and leverage. Now, this step is definitely not for everyone, but it's a critical piece of the puzzle for hitting that 1 crore goal. So what on earth is pledging? Well, in simple terms, you're using your long-term ETF investments as security, kind of like mortgaging a house. The key is you're not selling them. Your broker then gives you a loan or a margin based on the value of your holdings, and you can use that money for trading.
And here's a great visual for how that works. Say you have a 10 lakh portfolio. The broker might apply what's called a 20% haircut, meaning they hold back 2 lakhs just as a safety net. But they give you the other 8 lakhs as a collateral margin, which is often interest-free, to use for trading.
Okay, so let's recap. We've switched to low-cost ETFs, we're timing our buys to get a better price, and we've created a trading margin from our own investments. Now let's put it all together and see how the source says this all adds up to that incredible return.
This whole strategy basically has two engines pushing it forward. First, by being smart with your ETF buys and timing the market, the goal is to get a 20% annual return on your main investment, which is, let's be honest, pretty ambitious. Second, by using that margin you pledged, the goal is to generate another 36% return per year from trading. Of course, that comes with its own set of risks.
Now that 36% from trading might sound like a crazy high number, but the source breaks it down into what feels like a much smaller target. The idea isn't to hit a home run every day. It's just to have 3 good trading days a month, making a 1% profit each time you do. That's it. But obviously, being that consistent is the real challenge here and takes a lot of skill.
So here's the bottom line. If you punch the numbers into any SIP calculator, turning $5,000 a month into about 1 crore in 10 years, well, it needs an annual return of over 40%. But when you combine that potential 20% from your main investing with that 36% from trading, this strategy, at least on paper, makes that huge number suddenly seem reachable.
And that really brings us to the final question, doesn't it? This whole modified approach is clearly way more work. It's more hands-on, and it definitely involves more risk than just setting up an automatic SIP and forgetting about it. But it also lays out a path to a potentially life-changing amount of money. So what do you think? Is all that extra effort and risk worth that incredible potential reward?